and let's get into it. So the benefits of syndication: kickstart your real estate career with sweat equity. So we're going to make syndication simple, hopefully. So what is syndication from a 1,000-feet view? Because syndication is kind of a fancy word, but what does it actually mean? Well, syndications essentially allow investors to pool their collective resources. And again, let me actually turn off my video so you guys can see the slides more. So let me stop my video. Perfect. Okay, so yeah, I'm going to turn off the video so you can see the whole slide. My big face doesn't have to be on your screen the whole time. So yeah, what is syndication from a 1,000-feet view? It basically allows you to pool money together. So for example, when I was 20 years old, I did my first syndication. It was a 107-unit building. It was a $4.5 million building. And there's absolutely no way that at 20 years old I was ever going to be able to afford that, because, I was actually broke. I was a college student. I had negative money. I actually was in student debt. So you're able to use a thing like syndication and actually bring people with money to a deal that you know how to run, and then use information to actually gain equity. So you're getting equity from the sweat and information that you understand, and that's what syndication is. So there's two main structures for syndication. You have the Reg D, basically, is what we're going to talk about. So you have two regulations mainly, just Reg A and Reg D. Reg A is more like CrowdStreet, crowdfunding, and those are hundreds of thousands of dollars to set up. So I'm assuming that everyone here is going to be doing Reg D, and these are the two Reg D exemptions. So you have 506C as in Charlie, and 506B as in Bravo. So we'll talk about C first. C only allows accredited investors. So accredited means that you have $1 million or more net worth, not including your personal residence. And also it means that you're making $200,000 a year if you're single, and $300,000 if you are filing jointly as a married individual. So that's the accredited requirement. That's quite the requirement. So a lot of people do B because of that, because C, you can only actually raise money from someone who fits that description. And not only that, the issuer has to verify that the investors are actually accredited through a third-party verification service or by seeing their actual financials. So they have to have some sort of a situation where someone is verifying that they are actually accredited. They're not just saying that, they have the actual financials to back that up. So 506C will make you do that, which is kind of intrusive, because not only are you asking this person for money, but you're also asking for their finances. So it can be a little bit difficult, but it's definitely a more powerful way to raise money, because for the next point, which is that you can publicly advertise, which is really nice, but you can only publicly advertise to accredited people. So if you advertise and a lot of non-accredited people are inquiring, you can't accept their money. So you can only publicly advertise to accredited. And there's no limit on the amount raised, no limit on the amount each investor can invest. So that's what 506C is. And I do 506B, and the reason for that is because I can actually accept 35 non-accredited investors if they are, quote, sophisticated. So if I don't know people who are millionaires, then I can actually raise from some regular everyday people who are going to just have $50,000 in an IRA potentially, and they want to invest with me, and I can make that happen, especially when you're just starting out. Like me at 20, I didn't know very many accredited investors, so I couldn't really do the 506C yet, and I used the 506B to my advantage. So 506B, sophisticated, means that it's basically a statement that they understand their liability, because you're basically saying that they are sophisticated enough to understand what they're getting themselves into, basically. And the cool thing about the 506B is if they are accredited, you can rely on a statement that they're accredited. You don't actually have to get all of their financial info. You can just rely on a statement from them that they are in fact accredited. Then we also have no general solicitation or advertising. So this is a big caveat of the B exemption, is that we can't solicit or advertise. We actually have to have a pre-existing and substantive relationship with someone before we raise capital from them. And we're going to get into what that is in a second here. But the last point is there is no limit on the amount raised and no limit on how much each investor can invest. So what is a pre-existing relationship? Basically, a substantive and pre-existing relationship is more than just collecting email addresses. So you can't just have someone go and collect. You can't just mine for, or scrape for email addresses and consider that a pre-existing relationship. You want more interactions, because more interactions equals easier to prove. So if you just have one email with someone and it's pretty basic, like, hey, you want to meet for coffee? If you were to go to court and that person was to sue you and say hey, I didn't know you before you raised money from me, and the judge was like, okay, show me your history together, and you basically were oh, I have one email asking the guy to coffee generally. Well, that's a harder thing to prove, but if you have 45 phone calls with the guy, 30 Zoom meetings, and 55 emails that are all really detailed, I mean, that's a little bit excessive, but the thing is, more interactions would mean, hey man, there's no saying you didn't know this guy, you called him 50 times, right? So that's kind of the thought there, is how many interactions can you have with the person, how well can you document them, and that's just, keeping an email trail or a phone call trail, any of those things, because basically the whole thing is, if you were to get taken to court, would you have enough interactions with this person that would make it easy to prove that, yeah, you did in fact know them pre getting the deal under contract. So the advice on proving that you have one would be develop some sort of a record-keeping system to track interactions. There's softwares like Constant Contact, and you can also use introductory questionnaires on your website to sign and date, things like that. So just making sure that people are filling out questionnaires, interacting with content, and then you're following up with them and making sure that you're tracking all of those follow-ups just to make sure that that you have that whole thing situated. So Miguel asks, when do you talk corporation, do you mean LLC, S corporation, C corporation, and which is the better for real estate? I think LLC, but why? So I didn't really say anything about corporations, so we can talk about that later. But the LLC, essentially, from my understanding, an S corp designation, and actually I'm not even going to get into this because I'm not qualified, honestly. But basically, yeah, we'll talk about corporations at the end. Right now, we will, and also we have a little bit of a sub-segment that'll answer the question, what I think you're trying to ask. So we'll talk about that in a second as well. So equity split. The standard is 70-30. So monthly cash flow, if you have $10,000 of cash flow, the simple split would be the LP would get 7,000 of that, the GP would get 3,000 of that. And then if you had a profit from a sale or a refi, which is called a capital event, then you would split that $1 million profit, 700,000 to the LP and 300,000 to the GP. And that's kind of the standard equity split is a 70-30. The reason you would come up with a number for equity split is typically based on returns. So if you're going to give someone a 15% IRR and a 70% split gets them that return, then that's typically what you'll give them. If you can give them the same returns with an 80% split, then you may try to do that as well, because it's honestly more about the returns and less about the equity split as just an arbitrary number. You want to make sure that these equity splits are giving them the returns that you've signed them up for, basically. So hurdles, waterfall, prefs, these are all the same thing. To put it simply, I have a pie diagram here, which basically is, if it's an 8% preferred rate of return on a 70-30 split, that's a lot of jargon, but if it's an 8% preferred rate of return on a 70-30 split, basically what's happening is the LP is going to get the first 8 bites of that pie, and then what's ever left after their 8 bites, you're going to split that 70-30. So that's all a preferred rate of return or a waterfall or a pref or a hurdle is just basically you're giving them the initial 8 bites of a pie, and then you're going to split whatever's left after they've gotten their bites. So, syndication fees. There is 3 types of fees that you can charge here: the acquisition, the asset management, and the disposition. First, the acquisition is 1 to 3% of the purchase price, and that's going to go to the syndicator GP at closing. Typically, this fee is charged because you are setting up all the LLC stuff, you are setting up all the actual SEC documents, you're setting up the raising of capital, you're putting everyone into a deal. Not only that, you're finding the deal, you are doing the due diligence on the deal, you're negotiating the deal, you're getting the financing. You're doing quite a bit to close this deal. So you're going to get a 1 to 3% fee for that effort, and I think that's pretty well justified. And I think a lot of people agree with that as well. There's only one of these fees that's somewhat debatable to charge. The other 2 are pretty non-negotiable. So then you have asset management, which is another one of these that's pretty much non-negotiable because there's a lot of work justified in it. You have the asset management, which is 1 to 3% of gross income per month or per quarter or per year, whatever you decide. But it's basically on gross income. And so what happens is you're basically charging the asset management fee for the actual running of the property. You're doing a lot of the work day to day to make sure that these people are actually getting the returns promised and the property is performing. So there's a lot of reason for them to get fees because it's quite a bit of work as well. And then you have the disposition, which is on sale. So if you are actually going to sell a property, right, then there's a lot of work that kind of goes into bundling the sale and making sure that people can get that sell price that they're looking for, and that's going to be a 1 to 3% of the sale price. So I typically don't charge a disposition because I feel like if I'm going to charge upfront and in the middle, I also don't want to kind of charge on the back end as well. But some people do charge it. It's just kind of up to your preference, and also if your returns and your deal can support a disposition fee as well. So I personally don't charge one, but some people do. So what are these important documents? Because it's actually just 3 documents that allow you to do these exemptions. You have number 1, the PPM, the subscription agreement, and the operating agreement, and they pretty much cost somewhere from $10,000 to $20,000. I've seen it anywhere from like $8,000 to $20,000. It really depends on your lawyer and your personal situation and how complicated your documents are going to be. But we're going to break down what each of these documents mean right now. So first, we have the PPM, which is basically the private placement memorandum. private placement memorandum. Wow, that's a mouthful. But yeah, so it's a PPM, and basically what it's saying is it's going to let the investors know exactly what they're getting into. It's a factual document. It's not persuasive. It discloses like pure risk, and it shows you that you're being exempt from federal law. This is a private offering, and therefore there's a lot of risks associated with that. And basically you're just letting the person know honestly that you are going to potentially lose all their money, right? Like honestly, just to be super bluntly, like you have to let them know that there is a potential that they could come out of this with none of their own money. So that's just something that you totally let them know factually. It's a slight risk, but you have to inform them of that. And then Glenn's asks, are you equating asset management to also include property management? So no, they're not the same thing. Property management is a fee. That's a fee to the property management company for actually providing the managers and other services to the actual building, and that's where the property management fee comes, and that's going to be also on gross, somewhere from 4 to 7%, sometimes even 3. And then the asset management is to the actual GP partner that's overseeing all of those processes, because someone has to actually manage the manager. So the person who is managing the manager is who's going to get this asset management fee, because you can't just let a property management company go off on their own, because they don't know the budget and the kinds of vacancy projections you have and that you've been projecting. So you want to make sure that you're all hitting those numbers and everyone's staying on track, and that you're keeping them honest as well, because they can charge for repairs that aren't real. They can have units that are actually occupied that are called vacant and take cash under the table. So there's a lot of different things that you have to be kind of overseeing them and making sure that they're actually doing these things. And that is why you charge the asset management fee as well. So Bobby asks, would you raise capital to pay for the legal fees, PPM docs, or would you use the acquisition fee proceeds to pay for that? Yes. So Bobby, great question. You can do either one. So basically you kind of do both, right? So you're raising the capital and then you are taking the acquisition fee to pay that off. But often you can have a risk capital partner who can provide that, as well as the inspection fee costs, the earnest money deposit, and other things like that. And we'll get into what a risk capital partner is and what they provide in a second here. But yeah, you can basically bring someone into the GP just to pay those expenses so that you don't have to do that. Because again, when I was 20, I couldn't even pay for the PPM and stuff like that to do the deal. So I had to bring in someone on the GP side from the LP side and tell them, hey, can you pay for this upfront money? We'll give you slightly more equity for doing so. So the second document here is the subscription agreement, and basically this is where the LPs or limited partners sign to and agree to invest. So it's basically just the application to join a limited partnership. So they are right here signing on the dotted line. That's what this document's all about. Then the operating agreement is basically how GPs are going to run the property. Talks a lot about sharing distributions, voting, buyouts, all that good stuff, how you're actually going to operate this deal, and that's all that an operating agreement is. So GP roles, there's 5 main roles, and we've grouped asset manager and deal finder on the next slide because they have similar roles in some sense, and often they're the same person. But there's a lot of cases where the deal finder is its own separate individual. Someone can kind of just find the deal. They'll get less equity than someone who would also manage that deal, but you can be just a deal finder. So we've split them up into 5 key roles here, which is the asset manager, the deal finder, the capital raiser, the risk capital individual who we just referenced there, and then the key principal / guarantor. So the asset manager is the person who, we call it bring the discipline. They're bringing the actual management. They're going to manage the property. Then you have the deal finder who brings the deals. You have the capital raiser who brings the dollars. And then you have the risk and key principal who are people coming over from the LP side in order to bring some sort of a financial requirement. And we'll talk about all of these individuals here. So the asset manager and deal finder is basically the person who's going to oversee the management and operations, as well as maybe find the deal if they're grouped together. And this person is typically going to get about 35 to 50% of the GP for doing these 2 tasks. And their fees are mainly going to be from the asset management fee and potentially pro rata share of the acquisition fee. So they're going to be more on the asset management fee side. They'll be getting more of those fees than the capital raiser, obviously, because the capital raiser isn't really involved in asset management. He is somewhat. He's involved in investor relations, etc., but they're doing the brunt of it. So typically they'll get the most of the acquisition fee, or you can keep everything pro rata to keep it simple. But it's up to you as the GP. It really does depend on your individual property and your GP partnership. Then the capital raiser would be, typically it's just the acquisition fee, pro rata share, and they don't always get asset management fee, but sometimes you'll just do a pro rata split across all the fees, and that's totally simple and easy to do as well. And the capital raiser is usually somewhere from 20 to 40%. So typically a little bit less than the guy who potentially finds the deal and then runs the whole thing. That's typically going to be the majority of the equity, whereas the capital raiser is going to get slightly less. And their main active role is actually not raising capital. So it's kind of misleading to call people capital raisers, but your actual active role is investor relations. And the sub role is to bring investors into the deal and raise all or most of the capital. But actually, legally, we're not required to be directly compensated for raising capital. You have to be a licensed broker dealer for that. And we're actually, I'm not a licensed broker dealer. So if I'm raising capital for a deal, I cannot be directly compensated for the specific amount of capital that I'm bringing to a deal. That's not how it works. You have to be compensated as an active role under the guise of investor relations. So basically, I'm keeping up with my investors who invested in the deal. I'm letting them know what that all entails. And we're kind of talking all about that kind of situation because that is going to be basically the brunt of your active role. That's the only way you can justify it and not be a broker-dealer. So risk capital, this should hopefully answer Bobby's question, which is someone who is going to put up all the deposit costs, inspections, legal fees, and other escrow costs. And typically what you'll do is this will be someone who's already investing in your deal as a limited partner, and you'll just ask them to come over to the GP side, or you'll give them some GP share, 5 to 10%. And you'll say, hey, I'll give you extra equity if you just use some of the money you're investing in to pay for the actual upfront costs, which means they'll have to wire their money a little bit earlier than other people. And they'll also be potentially risking it, because the reason risk is the first word in this name is because if you actually back out of the deal before closing, you don't get some of these inspection costs back, some of these lawyer fees back. So they're actually risking that capital. It's potentially not going to be paid back. So that's why you have to incentivize them by giving them more equity. And then we have the key principal, who is the guy who signs on the loan in order to get the GP requirement met. So you have to have the net worth requirement for the loan, and we'll get into how to incentivize this person and how much net worth they need to have, etc. But basically, you'll give them somewhere from 1 to 10% of the GP for their signature. And so here's what the KAP really is the bank requires a net worth equal to or greater than the loan amount. And this net worth can be collective amongst the GP so that everyone signs and then their collective net worth adds up to it. Or you can have one individual who brings the whole net worth requirement. And so what you'll have to provide in order to do this is a schedule of real estate. If a lot of your wealth is from real estate, you'll have to prove that you own that real estate. And then number 2 would be 2 years of tax returns to prove that you have income. And then number 3 would be a personal financial statement or assets and liabilities to show that you do actually have this net worth, and it has to be, verified. So how do you incentivize someone like this to sign on your loan? Well, number 1, you would give them more equity, so 5 to 10%, 1 to 10% of the GP on top of their LP share. And then you're going to explain to them what non-recourse is. So I'll explain non-recourse very simply real quick, which is basically a non-recourse loan. You're not actually liable for anything over the collateral on the actual loan itself. So for example, if that person provides, let's say the KP has 50 other real estate properties and they're going to sign on your one property, if everything goes south, they won't be getting their other 50 properties touched by the bank. The bank's only going to come after this one property right here. And since they've already invested in it, they already believe in it, they've already seen the business plan, the worst case, best case, and they understand the risks. So they're already bought in, and now you're going to give them extra equity just to sign their signature, and they're actually not taking on any more risk unless there's something called a bad boy or bad actor clause, and this person is breaking some sort of major rule, and that's the only real way that they're going to be taking on more risk. But those are basically if you falsify your financials, like you literally lie to the bank, or you don't inform the bank that you're getting other loans, etc., things like that, you like break the law or break the rules of the loan, then the loan can become recourse, but that's pretty rare. And so if you explain to them the risks and benefits of non-recourse loans, then they're typically more incentivized to sign as well. And then number 3 would be that sensitivity analysis that I just alluded to, which is showing them the worst case scenario and then the best case scenario and everything in between. And number 4 would be the business plan, so what you plan to do, and lay that out really nicely to show that you've been thinking about this. So then we have here the soft commitment form. And this is kind of what you do at the beginning of escrow when you're under contract. You want to see how much everyone's going to invest. You want to get their commitment, a soft commitment. So they're not actually wiring any money, but they are going to tell you how much they're investing. You're going to get their name, their phone number, email, etc. If they're accredited, then their investment amount. And the really huge key question to ask in this period is, are you investing through an IRA or a 1031 exchange or cash? Because if it's an IRA, then you need to get them a custodian, and you cannot, that takes a couple of weeks, so you can't just like, hey, do an IRA, self-directed IRA into a syndication like in one day. You have to have some runway. So you need to make sure you know that early so that you can get all that set up and make sure that their money's in. Then the 1031, if someone's 1031ing into your deal, you can totally do it through a tenant in common, and we'll explain that in a second. But you need to know because, of course, that adds a whole nother layer to everything, and you have to change the documents to to say that that's happening as well. So you have to know these things, and if you wait till the last minute, till the subscription agreement's out to ask these questions, then you may have to completely rewrite the subscription agreement if it's a 1031, and the IRA, you may not even have enough time. So you want to make sure you ask before the subscription agreement documents are all ready with a soft commitment form, and that's what this is an example of right here. And then here you have what you're investing as. It's a really key question. I made this mistake my first time, and we had a last minute accommodate at 1031, and it was really stressful. But we got it done, but I don't recommend it. So you got to ask these questions definitely before you get all the legal documents done. Another thing here is the newsletter. So you want to provide, this is kind of the investor relations job. You want to provide quick updates, upcoming events. You want to provide a summary of the month, and then something fun like what you're reading, like that kind of section. And then lastly, a market report with data on the market that the deal's in. So if you're investing in Austin, you would have something about how Austin's such a great market, etc. And you just want to make sure that you're keeping some sort of a report so that you're keeping everyone informed. You break it up with a little bit of fun so it's not all dry and they actually want to read the thing. And then you just give them a summary of what's happening. Then a really key and overlooked thing is the investor gifts. Like this is probably, I would say, one of the most important things, and it's really not that much money to do. But you can get someone a plaque with their name on it for investing. We did a Louisville Slugger bat with their name engraved on it for the Louisville deal that I did. So it's really not that expensive. I think it's like $50 per bat, but you can see here someone did it for their wedding, and you have the groom's and bride's name on there, which is pretty cool because it just lets them know that you like care and that there's a real relationship here. And they've just given you hundreds of thousands of dollars. So it's pretty easy for you to be like, yeah, I can spend $50 on you. Like, you know what I mean? And it means a lot more than $50. So it's really important that you send these investor gifts and be a little bit creative if you can. The plaque and the glass trophy are pretty, like right down the middle of the fairway. You're not going to get in trouble for sending them, but you're not really going to raise too much attention. If you can do something creative like a Louisville bat or like custom jerseys, I've seen people do their people's hometown sports teams like with their name on the back of the jersey, because it really only costs you like $100 per jersey, and they're giving you hundreds of thousands of dollars, and the acquisition fee is more than going to cover that. So you might as well just spend a little bit of the acquisition fee on them, make them feel important, and have them come back and invest with you again because the overall experience is really positive. So then we have the K1 statement, and this is basically this is to report each partner's share of partnership earnings, losses, deductions, and credits. So this is where the LPs are going to see and the GPs are going to see their tax returns for the year from the deductions of the actual deal and their share of income, etc. And this is annually. So this is what you would actually get the IRS to send. And you basically get this as partnership interests, and it's the form. It looks like this, and it's pretty simple. It actually makes things a little bit more simple than you'd think. So when to send cash flow. You can choose these options right here, which is monthly, quarterly, and yearly. So for monthly, investors really like this, but it can be logistically difficult. So it's kind of hard to keep ample reserves when you're paying cash flow every month. And if you have a big mistake, but you're paying all the cash flow, then potentially you won't have enough reserves to kind of hold that off. So that can be some part of a negative there. And also the logistics of just paying that every month can be a little bit time consuming. So that's something to think about, but investors definitely love that. That's preferred for investors. They love to get monthly checks. Quarterly is probably a good happy medium. It's common, and it's a good balance of frequency and security. So you're still going to keep reserves. You don't have to be sending out every single month, but people are still going to get a decent amount of cash flow frequently, which is nice. And then yearly, this could be like for year one of the deal so that you can keep a lot of reserves for the property in the first year. And then after that, you can maybe switch to quarterly or monthly. But I have seen people do like the first year, we're only going to give you reserves once in the first 12 months. I mean, we're only going to give you cash flow once in the first 12 months, which is definitely, sometimes a good thing to be conservative. Who knows? And then logistics would be the ACH transfer. So a lot of people think you have to like write checks and things, but it is the 21st century. We can link this to the bank accounts, and we can do it in that way. So is there a limit to the amount of gifts legally? No, I don't believe that there is a limit, Bobby. I would say, and I'm glad you put legally because I was almost going to write that off as a joke, but I do think that you're actually totally fine to, it's almost like you have a pre-existing relationship with them. So even if there was some sort of stipulation, you could say like, hey, they're my friend. They invested in this deal. We have a pre-existing relationship. We're buddies, right? They just gave me $100,000. They obviously know you pretty well. So I think that there's no limit to gifts. And I'd say the more the merrier, honestly. You don't want to go over the top. That's a little bit weird, but I have seen people send handwritten notes, a binder with their name on it, and like all the logistics of the deal and all the facts and figures of the deal and how much money they're going to make. And then as well as like, baskets of food and things like that. Like you really want to go the extra mile on the gifts. I think it's really, really important. So how often does the year one scenario occur in practice? Typically, often, like honestly, a lot of people will do that. If you have a heavy lift for value add, you typically want to make sure that you're going to keep as much money in the property as possible. Because if you jump the gun and send out all these all these cash flow, and then you actually end up needing it and you have to do a capital call, that's going to look really bad. You do not want to do a capital call. So I'd rather be on the safe side and not pay cash flow out as quickly at the beginning because you're repositioning the property and a lot can go wrong. So it's kind of better to just to keep as much money in the property as possible. So here's the big question, which is, can you 1031 into a syndication? And the answer to that is yes. A lot of people don't think that you can, but you absolutely can through a tenant in common agreement. So in a TIC, basically each investor takes direct title to the real estate, so it becomes eligible because the LLC that they're selling their property in is now going to have direct title in common with the LLC that's buying this new one, so it becomes eligible because they have to be the same. They have to be on title of both things. You can't go from owning property to LLC to 1031ing into LLC interests. That doesn't count. So you have to actually be on title, and that's what a TIC does. And you can have up to 35 tenant in commons. So the bigger question, and one that no one really talks about, is can you 1031 out of a syndication? And yes, if everyone says yes, it's super easy. And also yes, if some people say no, but it's a little bit more difficult. So you have 1031 out of a syndication. Yeah, if everyone says yes, super, super easy. And then if some people want to cash out, then there's two options. So you have the swap and drop and the drop and swap. So we'll explain what these are in a second. But basically you do these if a couple of people are like, no, man, I want my money now. And then the rest are like, no, I want to keep my money in. So Miguel says, where do you find all that information? In a book, on a website? A lot of it comes from just talking to people who have done it before. I think that's probably the best way to do it. That's why, you got to network with people who are in the industry and doing things daily, because books don't really give you all the information. It's really hard to get every single thing you need from books and websites. You have to often seek out real people and also real experience. So jumping off a cliff before you're ready, that's kind of how I figured out tenant in commons. I didn't even know what a tenant in common was when I was doing a 107 unit deal. And a lot of people would be like, oh, you didn't know that? Well, no, I didn't know that. We figured it out as we went. It was difficult and I don't recommend it, but sometimes you have to just be willing to accept that you're not going to know everything and that you have to jump off the cliff and just have faith. And that was, that's really, I know that's kind of painful advice, but it's definitely kind of the truth. So what is the swap and drop? Basically what we're going to do is we're going to go ahead with the exchange or the swap, and we're going to just drop the investors or buy them out once we've actually done the swap. So that's what a swap and drop is. And here is a visual depiction. So the yellow faces, they want to get out of the deal. They want their money. And the white faces want to stay in the deal. So they're going to swap from this navy deal to this yellow deal. And then when they swap, they're going to buy out the other two. And those other two will have to pay capital gains on their buyout money. But the other people will get to continue on tax deferred. So these white faces in the new deal, they're going to keep their money tax deferred. And these guys are going to have to pay capital gains on the money that we bought them out with. Then we have the drop and swap, which is a little bit more complicated, but often it's a little bit more, for sure for everybody that you make sure that you're actually going to get your money. Because if you do the swap and something goes wrong and then you don't have enough money to actually drop those people, well, then you basically just keep them in and they don't really have any legal grounds to get their money back. So sometimes they'll be like, well, we don't really want to do the swap and drop because if something goes wrong, then we're basically stuck here. So that makes some sense, to be honest. So then you have to do something called a drop and swap, which basically means everyone who wants out of the deal, you make them a tenant in common, and then you do a quit claim deed with that tenant in common, and then basically they're a tenant in common with their respective percentage interests. So whatever pro rata share they have in the partnership, they're going to be a tenant in common with that interest, and then you're going to do a quit claim deed with them in order to leave. And then basically everyone else is fine. They do the 1031, and then those people are going to actually have to pay taxes on their quit claim deeds. So here's a depiction of that. First, you drop the guys who want to get paid, and then you swap into a new deal, and these guys continue on. So another huge question, and the one that we'll end with here, is refinances. Do I cash out the investor's equity and take 100% control after they refinance, or do I leave them in? And this is kind of a philosophical question to some degree. I would say totally leave them in, because if you blow someone away in an investment, people talk about when they make money in investments. That's typically like a really big thing people love to do. Like, oh my gosh, I made X% on this investment. Everyone talks about their stock plays. People will definitely talk like, oh my gosh, I invested in the syndication, and not only did the guy give me my money back, but he left my equity in and he continued to give me returns on top of that. So that's kind of blowing people away. And then you're going to get a lot of investors to invest again, number one, and also to tell their friends who will invest in you. And then you'll never have an issue finding capital again. And I can tell you that finding capital is not a fun thing, especially when you have a good deal and you just can't find the capital. That's really frustrating. So leaving people in is going to really build a good name for yourself. And I would say totally leave people in if you do a refinance. So now let's get into the Q&A and let me answer some of these questions. We didn't have quite as many today, I'm assuming, because this is kind of more of a dry topic, to be completely honest, but let me answer the ones that are in here. So we have Miguel, who says, maybe answer that question. If not, it's better to have 100 real estate properties share with other investors, or is it better to own 50 at 100%? It depends, man. I mean, we could answer that question numerically if we looked at all of those deals and we saw, okay, what's my equitable interest in those 100 versus that 100 versus that 50, and how much money am I going to make in each scenario? I would typically say it's better to have a smaller percentage of a bigger pie than all of a small pie. That's typically just the way that I would look at it, because number one, you have to understand, if you own 50 properties 100%, you're doing 100% of the work too, man. Like, it's all you. You have no team. You're doing it all yourself. You have to think about leverage in the form of capital, but also leverage in the form of time and people. So you don't also want to, like, you want to leverage the bank and utilize them to gain access to bigger deals that you couldn't otherwise afford. But you also want to make sure you're leveraging people so that you don't use all your time, because you're going to need to eventually have team members and help other people and have people help you, etc. So there's people who do own 50 deals at 100%, but I think it would be probably a little bit more efficient to have small shares in more properties than 100% share in less properties personally. So do you reduce, Matthew asks, do you reduce their returns or equity position on refinance? If that's what you're asking, I would say no. I don't typically want to do that. And if you're asking about the year one scenario, well, that would be, you would underwrite that in, assuming that you're not going to give them cash flow in year one. So it's all kind of already priced in, essentially. So Bruce says, what is a good size of apartment building to buy when you are first starting out to de-risk the investment, e.g. minimize the chance of a mistake, takes your investment under, oops, didn't realize I should have checked out the plumbing. Yeah, so good size of apartment building, personally, I think that this is going to be super counterintuitive, but I feel like if you invest in something over 75 units, you'll probably be in a good position, because then you at least have enough excess capital to have a full-time leasing agent and actually a solid property management company. You're not going to have to hire one of the lower ones in the city. You'll be able to get one of the better ones above that number. And then your job becomes a lot more easy, because you are 100% going to make a lot of mistakes on your first deal. Like, I guarantee it, there's absolutely no way not to. I know that from firsthand experience. You make a lot of mistakes. So the better partner you have as a property management company, the more well-positioned you are for those mistakes, and the more that they can minimize those mistakes as well. And that only happens if you have enough income in order to pay these property management companies. And that income only starts taking place around the 50 to 75 mark. But I would say 75, because we also want that leasing agent. So we're not doing any of that nonsense. We have a full-time leasing agent, a full-time maintenance tech, and a full-time manager. That's going to be an awesome team to have there every day, so that our job becomes just managing those three people, and our first deal becomes a lot more simple. So that would be my ideal size, would be 75 and up. Even though it's harder to acquire, your management, the 5 to 7 years you own the thing, it's going to be way, way easier. So take the pain up front and then, reap the benefits on the back end. So no on the refinance, sorry. So no, I don't reduce the equity positions. I would say keep everything the same, but give them their money back and just keep the deal cash flowing, because that's going to blow people away and it's going to give you a really good reputation. Are you involved in raise capital for QOZ projects? Can you tell me what QOZ, the acronym, stands for? I'm not familiar at the current moment, Glenn. So Miguel says, how to understand and analyze an asset class, real estate cycle, and how to know it's the right time to buy or the right time to wait. So a lot of the cycle is actually informed by construction and vacancy. So if you see construction really rising and vacancy decreasing, then you're going to see kind of an expansion period. And if you see that vacancy start to flatline or decrease and construction continue, then you might be in hypersupply. And then if you see that construction start to be completed and vacancies start to increase again, then you're potentially in sort of a recession period. So you want to make sure you're watching the building permits, you're watching the deliveries, and you're watching the vacancy in the market. And then you're also looking at how lenders are reacting to the market cycle as well. Because, like, for example, right now, lenders are requiring 9 to 12 months of reserves just to get into a deal. And so that means that they're pretty bearish on the market condition. And I would say that would hopefully inform you that maybe right now is not the perfect time to buy. It might be a better time to wait, unless you find an amazing deal that can justify those reserve requirements. But yeah, I would say look at the bank's opinion, not always investor opinions. I found that investor opinions are often clouded, because if you're an investor and you own thousands of units, and if the market is actually going to take a turn and you're going to lose millions of dollars, it's really hard for you to look at it objectively, because you have millions of dollars on the line. So you're kind of like, no, the market's great, man. You know what I mean? You're kind of like, you don't even want to look at it because it's too painful. So you can't really ask investors. You want to look more at the banks, and then you also want to look at deliveries and construction cycle and vacancy as well. So then we have Bobby here asking, at what stage should we plan to create the LLC or corp agreement? I.e., do you want it to capital raise with the LLC already existing, or gather your investors, find your deals, and then create the LLC? So I would say that you have to raise the LLC. You have to create the LLC before you raise the capital, right? Because they're investing, they're buying equitable interest with the subscription agreement into an LLC. So the LLC is going to be created at the same time as the PPM and all that other good stuff, because all those documents are basically giving you access to buy shares in an LLC. So the LLC will already be created. Oh, and then Glenn says opportunity zone. Sorry, I'm not the best with acronyms, but yeah, opportunity zone. I'm personally not, but I have heard really decent things if you can understand how to actually do that. For example, I've found that the local municipalities are actually the ones who draw the opportunity zone, and because it's not actually regulated federally or it's too difficult to, they're actually going to, I think, stop opportunity zones pretty soon. But the thing is, because they allowed local municipalities to draw the zones, there's been a lot of like an amoeboid shape, where people are drawing a circle around the area that's probably an opportunity zone, and then their buddy owns adjacent to it, so they kind of do a little amoeba outward loop to fill in that person. And there's been a lot of really interesting deals on the fringes of those opportunity zones that maybe shouldn't be included in opportunity zones, but are based on the drawing. And I know, like, Neil Bauer, for example, has done a hotel deal in the Pacific Northwest that's by no means an opportunity zone, but the zone was drawn very interestingly in that local area. So the opportunity zone allowed for even bigger opportunity than they maybe wanted. So if you can find situations like that, then that's amazing. But I think that's its own focus, and I think that if you are going to do that, it's kind of almost like your own niche, because it does take quite a bit of time to understand all of those things. But yes, so real estate investor, Miguel asks, real estate investors generally say that the best time to invest in the cycle, real estate is the recovery phase, but why is it not the hypersupply phase and the recession phase? Because a lot of people sell their properties to the price that they can really drop. But in recovery, there's some new properties constructed, so why is it better to invest? So Miguel, I think that the reason for that would be the recovery phase is, have you ever heard the phrase, don't catch a falling knife? That's kind of probably where that comes from. You don't want to be trying to time the bottom. It's a lot better to just buy as it's coming up, because you have more clear indicators that, hey, it's recovering, we can buy now, rather than trying to catch it on the way down, because maybe you don't know how far the bottom is. And that can be a difficult situation. Just let the knife hit the floor, then pick it up. Don't try to catch it as it falls, right? That's kind of the recovery phase argument there. And then the other thing with the hypersupply would be, in hypersupply, nobody knows it's hypersupply, or they're like ignoring it, right? Because greed kind of gets in the way, and they're like, hey man, we're getting big rents, we have no vacancy, yada yada, and they're actually thinking that their properties are worth even more. Like, for example, like late 2019 would probably be, in my opinion, considered a hypersupply. And if you try to buy a property in that period, I mean, cap rates are still low. People are still arguing that they're fine, right? And then there's not a recession, and their property is still worth a 4 cap in the Midwest, which it's not. But people will, it's very difficult to convince someone that their baby or their property is not as valuable as they think it is, especially in a hypersupply period where it's actually still doing well. So that's another reason why you can't really buy in that phase either. So it typically does come to the recovery stage where you're going to be able to actually physically buy deals. And now, what part of the cycle are we in? My answer to that question would be, I mean, honestly, I don't have a crystal ball, and I almost don't want to have an opinion on it, but I would say that it doesn't look good, in the sense that maybe we're not really fully experiencing a recession yet, because there is a lag in the real estate market. There always has been. But I don't see how it's possible that if we do go to another shutdown, I mean, all signs are kind of pointing to that. For example, I live in Texas, and we're actually shutting down a lot of things now. We opened up, and then we had a big case leap forward, and now we're realizing, oh man, we might have jumped the gun here, we're gonna have to shut things down again. I'm not sure how much the economy can support another shutdown, so I'm not sure that we're gonna be in a good position as far as the overall economy is concerned, which would lead me to think that we're heading into a recession. But again, I don't have a crystal ball, I'm not an economist, I don't think I know everything, and I don't want to take a guess on this, because I really have no clue, and I've been wrong multiple times before. But I would say that, there's a lot of signs pointing to the fact that we may be entering some sort of a recession, for sure. So Matthew asks, what are your best approaches for sourcing investors? And says, turning your camera on, Adam. Yeah, I can turn my camera on if everyone wants to see my face, for sure. Yeah, hey guys, how are you? You never know. So Matthew says, what are your best approaches for sourcing investors? My best approaches would honestly just be to go to Bigger Pockets and LinkedIn and things of that nature, and to send DMs and ask people how you can help them. And you want to help some more, help another time, help one more time, help two more times, then ask. Like, you really don't want to be the guy who goes out, hey, I got a great deal. You want to invest with me? Like, they don't even know you yet. You haven't done anything for them. So you want to have some reciprocity there. You want to make sure that you're giving some more, and then asking. Because you definitely, every time I coach students on this, I'll have a couple of students who get a little bit too ambitious. They don't read the scripts and they just go out into the world and ask people for money. And dude, like, have you ever, like, remember when you were a kid growing up and you just asked your dad for $5? He wouldn't even give you $5, and he's your dad. You know what I mean? Like, it's your dad. So you got to build some reciprocity. You got to give them a reason why. You can't just ask for money blatantly. Even your family will say no to you. So you cannot just ask for money openly. And I would say that's definitely my best approach, is just give as much value as you can, man. And things, you will be rewarded. I honestly have firmly believe that. And I've seen that in my life, where if I do things just for the good and the sake of doing good things and for helping people understand things, then you're always rewarded, like every single time, right? As the tide of the ocean goes out, it has to come back in. As your heart beats blood out, it has to, circulate it back. So it's the same thing, right? It's kind of like a law of the universe. So just try to give as much value as possible, and I promise you'll be rewarded for that kind of things. So Miguel asked another question, which is, do you suggest invest in a lot of countries or just invest in one? I have a whole presentation on markets, and I think that, it's he who chases two rabbits catches none. That's kind of the quote that I use there, which is, you can't chase two things at the same time and catch either of them, right? Your time is split too much between two tasks. So I would say that it'd be probably better to focus on one country and understand it, because there's a lot of different laws from country to country, and I don't even know any laws from any other country other than the U.S. So I'm assuming there's a lot of variety there. I would be really surprised if there wasn't. So I would say focusing on two countries is going to be a lot of mental time that you could be spending otherwise focusing on one country. So that would be my suggestion there. Glenn says, what methodology do you employ to underwrite the exit cap rate to determine IRR? So exit cap rate for me, I do 10 basis points per year of ownership. So, that's 0.1. So if it's 5 years, it's 0.5 on the cap rate going up. So if I buy at a 6 cap, hold for 5 years, I'm going to sell at 6.5. But right now with like this situation, I mean, I would be a liar if I told you I knew how to underwrite exit cap. And that's a big reason why I'm not really buying anything right now, because I don't really know what rent growth looks like for the next couple of years. It's probably going to be 0 or negative, but I don't really know. And then we have vacancy projections, which it could be 10 plus. It could be, I have no idea, right? Like it's too unknown, right? There's too much uncertainty. So any predictions at this point and any kind of strategies or methodology is a little bit of just shooting in the dark. But normally in a regular situation, when we don't have a pandemic, I would say it's typically the rule of thumb is 1 basis point or 10 basis points per year of ownership. So that's, I guess, the general answer there. But again, take that with a grain of salt, because we are in a unique situation. Chrissy asks, where to look for investors again? You said Bigger Pockets and another site. Oh yeah, so to slow it down, it's biggerpockets.com and sending the DMs. And then also any social media, to be honest, but LinkedIn is probably the best one. So again, that's LinkedIn. LinkedIn is great for business. There's a lot of people on there who are business specific, and you can search for people by title. So like, for example, I studied neurobiology in college. So I searched a lot of neurosurgeons because, number one, neurosurgeons make good money. I figured that they would have money to invest. And they're also busy, so they can't invest themselves. So I figured they'd be interested in passive investing. And then thirdly, we have a common ground. I studied their subject a little bit in undergrad, so I understand kind of where they're coming from. I have a sympathy for doctors because I understand the workload that it takes for them. So I'm kind of like, I would open with that sort of situation. Like, okay, how can I help a busy doctor who does a lot of good work for the world, but doesn't have enough time to invest his own money? So maybe I'll reach out with that. So maybe just think of any sort of similarities you have with people. Maybe your mom's a dentist, so you want to reach out to dentists and say like, hey, I really know what it's like to be a dentist. I watch my mom work long hours. I'd love to help you out with investing, something like that. Just be creative and reach out to people by job title on LinkedIn. I've found that to be really effective. So that's typically a good piece of information there. Brandon says, do most syndicators do this full-time, or do you see some with other full-time jobs as well? Basically, do you see it to be feasible to do both? I would say, Brandon, it's absolutely 100% feasible to do both. I've seen a lot of people do it. I personally don't, because I really like real estate and I wanted to do this full-time. That was my whole goal. So I made sure that I could do this and then become full-time as quickly as possible, and I have. So I think you obviously would have an advantage being full-time because you simply have more time and less focus on other things. So my whole focus is on real estate. I can underwrite a deal at noon, whereas you may be at your job. I can go visit a deal at 3 p.m., whereas you may be at your job, and I might get the deal over you. So you have some issues there, but you can totally do both. I know a lot of people who do, and I wouldn't let that hold you back if you do work another job that you are passionate about. So yeah, I would definitely say try to do both, man. And then Matthew, are your other presentations available to watch? So yes, Adam, can you put the link to the YouTube channel in the chat box for Matthew and for everyone else who wants to watch the other YouTube videos that we've had? Because we record all these webinars and we put them on YouTube. So Adam is going to put the link in the chat box for the webinar. So yeah, I mean for the YouTube, and there it is right there above you. So if you click that link, you'll see it. And then also, Adam, if you could put the link to the deal analyzer in the chat as well. I forgot about that, so thank you for reminding me there in the chat. But yeah, we're going to do the deal analyzer. So we have a deal analyzer that helps you to underwrite deals and find out how much your investors can make and how much you can make actually as well. So there's the link to download that analyzer, and you can utilize that. And yeah, totally helpful for sure. So Trisha asks, when you source investors, letting them know you want to help them in what way, like volunteer for their events? Helping them understand real estate and showing them the benefits of real estate, not because you want their money, but because you really genuinely think that this is something that can change their life. And you actually mean that. I don't mean that as like a sales tactic. I'm not trying to be clever here and be like, oh, well, actually, there's some psychology behind acting like you care. No, like you literally have to care. And for me, man, real estate has changed my life entirely. It's taken me from someone who was just following the status quo, head down, trying to be a doctor to please everybody else, to a person where I actually really enjoy my life at the moment, and I get to spend time with my family. I get to do the things I love. So for me, I was like, I understand the power of real estate. It allows you to be passive. I really want to help people who are busy professionals, especially someone who I care about, like doctors, for example. I almost went down that road and dedicated my whole life to that, which is a lot. I see people who do that, and it's a lot of work. So if they have no one who cares about how much, where their money's being invested, they have no sort of retirement plan because they're so busy on their craft, and their craft is helping people. Doctors help people. So for me, I was like, I'm passionate about this. I want to help you. I want to get to know you as a person and your situation. And then I want to put myself in a position to actually improve your life, and like genuinely from the heart, not because I want your money. And I think that that's like literally just the best way to raise capital or really ask for any sort of thing. Like if you have a social media campaign and you sell dog treats or something, I think that's also another great strategy. That's always the strategy, right? Your social media post for your dog treat company should be, these dog treats changed my dog's life, and I actually like genuinely mean that, and etc. So you get the point. But that's typically the help is really that personal. So yeah. Miguel asks, do you think it's possible to find a way to acquire 250 doors in real estate per year? And if yes, how? Could you give an example of the technique? You just watched the technique. Syndication, 100%. Yeah, I required 107 units in 6 months at 20 years old. So it took me 6 months to do my first deal. I was 20. I had no experience. I'd never done any real estate, period. College dropout, like I dropped out of college my sophomore year. 6 months later, did a 107 unit deal. So you can totally do 250 units a year. I know people who do thousands of units a year from syndication and from other models like that. So syndication is basically, you don't need any of the money. You just need to find the deals and be able to present them to investors and raise the capital. So if you're looking for that strategy, I mean, you've set that up perfectly. I appreciate the softball, but yes, this is the strategy, right? Like just not, this is definitely the strategy to allow you to get the 250 doors per year. So Chrissy says, will webinars be available to watch later? Great info. Yeah, Chrissy, so that link in the chat, if you open up the little chat icon, you'll have a link from Adam to all panelists, and it says kylemarcotte.net/YouTube. So it's a short link to my YouTube channel, and all of my webinars are recorded on YouTube. And this one will also be there when it's done. So yeah, and then Miguel asked the same question, but yes, that is definitely the best way to do it for sure. So I'm going to end this at 8. So we have 8 more minutes, like hard exit at 8. But if you have any more questions, just feel free to keep asking them. I'd love to answer them. And yeah, I think we just got another one. Where do you find the members of your real estate team? This could be, again, the same sources at BiggerPockets or LinkedIn, or just going to local meetups in your market and networking. Like there really is no substitute for networking. You just have to meet people with skill sets that are complementary to yourself. So for example, I met an individual named Eli for my first deal, and he was an actuary. So if you're not familiar with actuaries they basically they work for insurance companies. They try to predict when you're going to die mathematically with a lot of different ads. So they're a lot of different assumptions and things like that. So they are, very mathematical, very spreadsheet oriented. So the guy really liked underwriting deals. He taught me everything I know about underwriting deals. He's very, very, very analytical. And at the time I was just like, hey man, I'm speaking at a meetup in the Bay Area. I'm working my tail off to network. I'm trying to meet as many wealthy people as I can. I'm trying to explain real estate and its value. And I think I have a pretty decent investor list. If you can find a deal and show me that it makes sense on paper, then I can present it to this group of people and we could potentially do this deal together. So that's kind of a complementary skill set because Eli just wants to be in his room underwriting and I want to be out in public talking to people. So it's really complementary and we can come together and both do our strengths. Oh, Miguel says, I still have 3 questions. I'm sure you do, man. I appreciate it. You're 15 years old, so I'm going to answer all the questions I possibly can for you because I can't even, like, it's honestly insane that you're 15 and on here. I don't even know what I was doing at 15, but it's probably embarrassing. So I'm just excited to see you on here. So yeah, feel free to keep asking questions, man. And also everyone else, feel free to ask questions as well. We still have a decent amount of people in here, so feel free to ask questions. I'll answer them again until about 8 o'clock, so that's 7 minutes. So we have about 5 to 7 minutes left of questions, and then we will end it. So long question. I'll try to read this. What suggestions from Bobby? What suggestions would you have for someone who is implementing the strategy from your previous videos, like capital raising, setting meetings with potential investors, as well as emailing, networking with brokers, but then you happen to find a deal in the first 1 month versus 5 to 6 months when you might have been able to get a few more soft commitments? So if you find a deal in the first month, like hallelujah, praise the Lord, like good for you, I'm really happy. That's really, really unlikely, but like let's say it does happen. I think my first course of action would be to find someone who does have the capital prepared and just give them the deal as either a wholesaling fee or tell them like, hey, I'll come on as a GP. We can do this deal together. I found a great deal. It makes sense for this. I'll do my best to run it, or you can run it because I don't know anything. I'm 1 month in, and you can say, here's a deal, because deals are the hardest thing to find right now, man. If you find a good deal, they're literally like, it's gold. Like it's so hard to find a deal right now because of the fact that banks are not lending in the same way that sellers are kind of selling their properties for. So there's a disconnect between banks and sellers. The banks want a bunch of reserves. The sellers still want the high price from January, and there's a huge disconnect. So if you can find a deal that makes sense right now, you will be like the pretty girl at the bar, kind of, so to speak, as an analogy. Like everyone's going to be wanting to come up to you and talk to you and introduce themselves to you. So if you find a deal, you will not be pressed for individuals to talk to and say, hey, can you raise money for this deal I just found? And hey, can you teach me how to operate it? And I'll take either a fee or some small percentage and then learn everything you know. So I think that would be probably the strategy, Bobby. So then Glenn here, are you presently waiting on the sidelines with dry powder with the presumptions of finding COVID discounting? In New York, we're waiting, but the needle hasn't moved significantly yet. But I assume after the next quarter, the shoe will drop as the bank forbearance period is over. Yeah, Glenn, I am kind of sitting on the sidelines as well because I'm totally on the same page as you, where I think that there is going to be a significant change coming soon eventually. I mean, August will kind of be the canary in the coal mine. We'll see what the world looks like after August. I think that's going to be a big indicator as to what the future looks like. We'll see if we close again, like in Austin, in Texas, and Florida, and some of the other states that opened early. If we close those states back up in August, there's going to be a really weird situation towards the end of this year. And I definitely don't want to be trying to close a deal during that weird period. So that's kind of like I'm waiting for that situation. But right now, in the meantime, to bridge the gap, we're starting a fund. So I'm trying to start a fund where I can raise capital and get an actual commitment from people where they sign a document, they give me 10 to 20% of their investment, and we're starting to group together a fund of capital so that the capital is actually accounted for and real, not just a soft commitment, but real capital in a fund. And then we're going to actually invest that fund when these deals do open up so that I don't have to raise capital and then also be having all these deals come to market. I just want to have the capital ready. So that's kind of what I'm doing to bridge the gap right now, is just starting a fund. And I think that's probably the best way to kind of sit on the sidelines, but also be like, stocking and, getting some ammo ready instead of just kind of sitting on the sidelines. So that would be my advice. If you can start a fund, I'd say try to start a fund. So limited partnership, is it a syndicate? So a syndicate basically means you're pulling together money for something. A limited partnership is basically means that like you have a general partnership and a limited partnership. The general partners, they have the actual active role. They have say in the deal. The limited partners, they have no say in the business operations. So the GP is like, hey, we're going to sell in 5 years. The limited partnership can't say anything about that. They're just bringing the capital. So that's what the limited partnership is. They're the people who are passive. All they do is give you the money, and they do none of the work. The GP does all the work and doesn't typically bring any money or less money. So Miguel says, I read a lot of books on real estate, online business, and personal development, but I don't really know a lot about how banks work, how a loan works. So I'd learn the bank world. So what book do you recommend on learning bank and other techniques to learn that world? The bank, man, I mean, honestly, it really comes down to just, honestly, looking at there's really no book. I'm trying to think. Okay, well, actually, there is one book I can think of, and I think it's How to Creatively Finance Real Estate. And the author is a female. I forget what her name is, but there's very few finance books written by women, to be completely honest. So I think that you'll find that one pretty easily. I believe her name is like Susan. I forget, but it's a blue book with like there's glasses on the front right corner, and then you have the home in the background, and you have glasses on the front right corner of the book, like that have been taken off, obviously, and it's called like How to Creatively Finance Real Estate. That was probably the first book I read on real estate about 2 years ago, on real estate finance, and it definitely helps. So that's a decent situation there to read. And then we say, Glenn here, are you presently waiting? Okay, that was the same question. Private commitment, let's talk offline. My cell is 515. Yeah, of course, man. I love that. So, yeah, Adam, feel free to add that email list and send him an email and other things. Yeah, Matthew Meyer, Susan Smith. Yeah, I nailed it with the name. Look at that. I visualized the cover, got that dyslexic brain going, and we figured it out. So, yeah, that's a great book. Thank you for the author's name. And there's Adam, who has shown us the link. Always Adam, awesome guy. So appreciate you so much. Could you write the name of the book in the conversation, please? Yeah. So that's the link right there, Miguel. Adam has put the link to the book directly. So that's definitely a good book. It talks a lot about some of the basics of financing. That'll definitely help you out with the banks. Then Miguel says, I am not a U.S. citizen, but how does U.S. real estate investor can invest in all states because the rules can change state to state to another? So yes, we can invest in any state. And the thing about the rules and regulations is typically a lot to do with tenant laws and taxes and things of that nature. So for example, Texas has really, really high property taxes, which is just something to consider. When you invest in Texas, you're going to have to pay about 2% property tax, which is pretty brutal. But, there's other benefits there, especially job growth, et cetera, tenant laws. And tenant laws, like for example, and you have a city like in a state like California, you have the laws that are more favoring the tenants. Okay. Yeah, I apologize. I've just read that email out loud. No worries. But yeah, so basically California would say that they're favoring the tenants and not the actual landlord. So what happens there is, man, I'm sorry, I just blanked. But yeah, basically California is going to favor the person living in the apartment, not the owner of the apartment, where Texas is going to favor the owner of the apartment and not the person living in it. So that's kind of the big variation. You want to make sure that you kind of figure that out. So yeah, Adam, I'll Slack you in a second. I'm still figuring out the whole Zoom world, to be completely honest. So Miguel, what do you prefer between Chris Cohn with single family and Grant Cardone with multifamily? And I have the last question. Yeah, Miguel, Chris Cohn and Grant Cardone, I will say only positive things about other people because that's how I was raised, and I will make sure to continue with that precedent. So I will say that they are both great individuals. And they have different strategies than me for sure, but I respect what they do. And I definitely think that if you were going to pick one of those two individuals, I would say always go with the multifamily individual, which is Grant Cardone in this scenario, just because multifamily is a much better asset than single family, in my opinion, based on risk, scale, a lot of other situations like that. So that would be my situation. So Bruce Peterson, to all panelists, basically says, my friend recommended not to invest in real estate until you had $200,000 in capital lying around. Curious if you have any thoughts. Well, I mean, I don't really know. I mean, it's totally personal preference. It's a risk situation. It's a risk tolerance situation. It depends on, I mean, you could make the argument that yes, until you have your, get your room in order before you go out into the world sort of situation, like make your bed before you tell other people, all this other stuff. So that would be the situation of like, make sure your personal finances are taken care of to the point where you have 200,000 liquid. That kind of makes sense in some sense, like if you're being very conservative, but also, you don't want to, I mean, you can wait till 200,000, but I think there's other options to get in earlier. It depends on your risk tolerance. But I would say that I typically don't accept people into the syndication if it's like they're only $50,000. So if someone only has $50,000 saved, like total, they have no other savings, and then they're like, yeah, I want to give you my $50,000. I typically don't take those people in the deal because I'm like, okay, man, I don't want to like be responsible for your nest egg, like your whole savings. Like I think that's risky. So I'll tell the person like, hey, save your money, build your stuff up a little bit more, and then the next deal, let's get you invested. But let's make sure that your personal finances are taken care of first. So I think that your friend is being maybe a little conservative with the 200,000 number, but I would say like, yeah, make sure you have some decent money saved and you're not investing all of your capital. Because I think that anytime you invest 100% of any of your working capital, that you're kind of taking a big risk. So I would say, like, yeah, maybe, I don't know if the magic number is 200,000, but I would say that something along those lines of making sure you have more than just the money you're investing, for sure. So I hope that answers that question. Can I ask how much you had saved away when you first started? Dude, I had student debt. I had $0 saved. I'm not the paragon of risk tolerance or risk assessment in any way, shape, or form. 20, like, and I would not take advice from me as far as risk is concerned. At 20 years old, I would not recommend to anyone what I did. So I was 20 years old. I had a full Division I soccer scholarship, and I had the ability to study neuroscience at one of the best universities in the country. And I decided to forego all of those secure things to go and pursue something that was completely unsure and uncertain. And I had no money, and I had student debt, and I had about, I think I had like $10,000 or $8,000 saved. It was just enough to pay for my living expenses for 6 months. And then I actually, the week before closing, so the week before I would actually make money, like everything would close and I would actually make some money, I actually couldn't afford my groceries. So like 1 week away from closing a $4.5 million deal, my roommate had to buy my groceries at Safeway. So I do not recommend what I did, man. Like one of the most stressful 6 months of my life. I made it happen because I put myself against the wall and I burned the boats, and I made sure that I couldn't do anything else. It was one of the worst and most stressful periods of my life, but it taught me a tremendous amount about myself and about pain and about life in general. And I definitely think that I wouldn't trade that experience for the world, but I would say that I couldn't in good conscience recommend anyone to do that, but it did work. And yeah, yeah. As far as reserve requirements are, I'm definitely not the guy. So Matthew, my story, yeah, appreciate it, man. I appreciate the kind words, and yeah, have a good day. So Glenn, we have some more questions, so I'll keep answering them. I was going to end 4 minutes ago, but it's fine. I'll answer a couple last questions, and then we'll wrap it up here in a couple minutes. We have Glenn, which says, typical hold time for a pro forma to get your IRR business model. Typically somewhere from 3 to 10 years. That's my general answer. Ideally 5, but somewhere from 3 to 10. And then Bobby says, do you have reservations about raising capital from family members? Bobby, so there's a lot of different thoughts on this. Like you have the, I forget the guy's name. My gosh. The bald guy, Dave Ramsey. There we go. So Dave Ramsey is basically the guy, if you've ever read any of his books, he's like, do not mix family and money. Don't mix it at all. Don't mess with it at all. And I kind of tend to agree with that in some sense. But if you kind of have really good boundaries with your family, I don't know your personal situation. Some people have no issues or qualms about raising capital from family. I kind of don't do it. Well, personally, I didn't have the option because my family's not very well off. My dad cleans pools and my mom's a yoga teacher, so super blue collar family. That's kind of the reason why I wanted to get into passive investment and understanding money, because my family didn't understand it right. So I grew up with absolutely no understanding of money, total financially illiterate family. So there's absolutely no way that they were going to be able to invest. So that kind of made that question easy for me. But if you're from like a very wealthy family and you have good boundaries with your dad or your mom or your cousin or your brother, and they understand that, hey, someone like Bobby might lose 100% of this money. It might be completely gone. Like he might totally ruin this. I can afford to like literally burn this money on fire. Then I would say, yeah, totally take their money. But I would not make it an awkward Thanksgiving by taking your brother's last $50,000 in the fingers crossed hope that your multifamily deal works out. Because although it's really highly likely that you will actually make some money in multifamily, the default rate in 2008 was 0.4%. So you have a pretty good chance. But the thing is, why risk it? Why risk the family connection if it's not, money that this person doesn't really care about? Like they have so much money that it's not a big deal. So that would be my advice there, being conservative. So, yeah, Miguel, we'll have to set up a call or something because you have a ton of questions and we are going to go in over time here, but I will answer one more of yours and then Glenn's, and I think we'll call it a wrap after that. So Glenn says, is that a picture of Manhattan Bridge, the eyes of the native NYer? Notice it. Yeah, so Glenn, my mom's from White Plains, so we have a ton of New York pictures that I've inherited over the years. So, this is one that, because as a 21-year-old, I don't have any pictures to decorate my place. So I was like, hey, can you send me some of the stuff we don't use? So it's a bunch of New York stuff that I've never seen before. But yes, I believe that is Manhattan Bridge. And across from me and out of picture is the old New York picture where like New York's super big and then everything else around it's super small. So we have that like old, kind of classical painting there that's, was in the attic or something. And I took it when I had to decorate my place. So that's the story behind that. Yeah, a little TMI there. But yeah, that is the Manhattan Bridge. So Miguel, you won't do a webinar, but could you send any questions by emails? Yes. So email me, man. Yeah, email me your questions. You have a ton of good questions, and I'd love to help you out. So feel free to email me at info@KyleMarcotte, and Adam will forward it to me, and we'll make sure that we get those questions answered for sure. So again, that's info@KyleMarcotte. It's actually on the screen here. So yeah, email that email, and I'll definitely get you taken care of. So yeah, thank you guys for all the questions. Thank you for showing up, and I hope it was a lot of value. We're actually, not going to do any webinars in in July, because we're going to be building this course that's coming out in August. So stay tuned for the course if you're interested in that, and we'll be sending a lot of info on that as well. It's basically, we've been using the webinars to test the quality of our information, and people have been responding really well. We've had hundreds of people sign up for the webinars, which has been awesome. So we're actually going to take July off just to focus on making a standalone product that people can enjoy at the same level of this all the time. So that's what's coming out in August, and that's what we're working on in June. So there you go. That is what we are doing. But yeah, I appreciate you guys for coming, and I will see you guys later.